Good morning, everyone. Thank you for joining us for today's webinar on DCF adoption for commercial real estate and valuation, more specifically in Europe. My name is Julian Sporgidis. I'm a strategic client partner for Altus Group, and I will have the privilege to moderate today's panel discussion. Before we get into the details and kick this off, I do want to note that this webinar is being recorded, and everyone who registers is going to be given access to the webinar. But more importantly, we have a great panel lined up for you guys today and I will start with the introductions, but hand it on to you guys. We have Lloyd Harrison, Associate Director and the Fund Analysis Team at Invesco. We have Pierre Boucher, who runs the cross-border valuation teams at Cushman & Wakefield. And then we have Nicolas Le Goff, who is responsible for the valuation management activities of Altus Group in Europe. I do want to allow you guys to introduce yourselves as well. So maybe we can start with you, Lloyd, if you don't mind.
Sure, thanks, Julian. So Lloyd Harrison, I'm a member of the fund analysis team at Invesco Real Estate. I am a core part of just a single portfolio. For the 4 years I've been here, I do most of the numbers on transaction underwriting when we go through acquisition and disposal, IC papers, our annual business plan meetings, and our fund strategy reviews, which valuation forms the key part of most of those things. And prior to the 4 years at Invesco, I spent 6 years at Knight Frank in both London and Dubai. And maybe on to Pierre.
Yeah, thank you, Lloyd. Good morning, everyone. My name is Pierre Boucher. I run the international cross-border team at Cushman & Wakefield. So my day-to-day job is valuation. And my team work closely with the entire C&W valuation network across EMEA. Our main focus is the delivery of valuation for clients who have a pan-European exposure. So all the big banks, obviously the big funds, and all clients who want to understand what's going on across Europe. So we are the main point of contact at Cushman.
Excellent.
Thank you. And hi, everyone. So I'm Nicolas Le Goff. As you mentioned, Julian, I oversee the advisory practice of Altus in the EMEA region. And our main focus is to provide valuation management services to our clients. So effectively, we sit in between valuers and valuation teams and real estate funds with a focus on pan-European funds in this region, obviously.
Excellent. So thank you for providing that additional insight. In terms of agenda today, there's some good content and we have a lot to cover. We're going to kick things off looking at the current status of DCF adoption in Europe overall, and would love to have your house views as a part of that first topic, but also going to look at opportunities and challenges and discuss what your experience is and has been so far, and then also, more importantly, the outlook in the next 24 months. Are we going to see an increased, pace of adoption, and what are the sort of expected trends from a valuation standpoint? So a lot to cover, great content. And my suggestion here is to transition directly into the current status of DCF adoption, because there's been a lot of discussions for the past couple of months, primarily driven by the RICS consultation process on DCF. But I think there's an argument, and one can argue that the motion and DCF adoption was already, in motion prior to these discussions. So these discussions is more an RICS consultation process, a catalyst, but things have been, starting prior to that. And it would be great to get the views of the panel, maybe starting with you, Pierre, on how your business and organization approaches, the DCF adoption and what your house views are?
Yeah, good question. So let's start with that. I think that obviously DCF is not something new in the valuation world, and this is a methodology which has been used for many years in many countries across Europe. We have, in a lot of countries, usually two methodologies was going to be the DCF and the traditional approach. In some other countries, it is true that DCF is a less used methodology. And for example, in the UK, where traditional valuation is something which is very strong in the UK industry, but we are moving towards DCF also in the UK. I think that you need to bear in mind that the key point here is also to answer what our clients' needs are. And obviously, there will be the change from one methodology to another, so moving, for example, from traditional to DCF, will be also driven by investors or clients' needs. So what we try to do, obviously, is to provide valuation that mimics the way the market function. And it's true that our investors, our clients, are more and more sophisticated. And in terms of conversation for them, it's very important to understand where the values are coming from, what are the key parameters that come to a conclusion, and using DCF help us in going into more detail into this process.
Excellent. Thanks for that intro, Pierre. And maybe moving on to you, Lloyd, on your house views.
Well, before the house view, I think I've shared my personal view. Over 10 years of transaction underwriting, I've always just looked at DCFs, right? And working within Invesco, we go through a lot of transaction underwriting in DCF format, and I've always wondered how you to evaluate a property as a market participant would, to pay the same price, to value it as what a market participant would be willing to pay, should probably just be using the same technique fundamentally. And so I think in the high inflationary environment that we had over the last year, we started to see in the portfolio we cover a couple of discrepancies where, because inflation was not modeled into properties that had hurdle rates in their lease contracts, there was a bit of a fudge in the traditional valuation methodologies to try and overcome this. Naturally, when we moved all of our assets into DCF format, that's accounted for in the forecast, and it's modeled the same way that we model all of our business plans in-house and all of our transactions. So having gone through that process for us, there are a huge number of benefits we've been able to find in the comparability between our in-house business DCFs and what our valuation advisors are putting together for us as well.
Right. And so yeah, definitely echoing more what Pierre is saying. It's driven by client, requirements, and good to have that sort of validation at your end, Lloyd, looking at it, more from a client perspective in this case. So that makes complete sense. And Nicholas, would love to have your complementary, view as well, based on what has been discussed so far.
Yes, and I can very much echo what both Pierre and Lloyd are saying from a slightly different vantage point, from sitting in between valuation firms and our clients' investment funds. We can definitely see that the requirements for DCF methodology specifically from our clients in mandating valuers and requiring valuations has gained a more central point of focus in the actual requirements. So it's gaining traction, and the number of requests to get specifically DCF valuations is increasing, and has been increasing quite significantly over the past maybe 6 to 12 months.
Yeah, no, agreed. So we do definitely see that increase in adoption pace, especially in the pen. European open-ended space. And I guess if we do a bit of a drill down and a deep dive in the opportunities, I mean, I think there's a strong case, and we started, touching upon it, for more transparency on fundamentals, the ability to compare, your portfolio geographically, if you're a global investor. Can we sort of do a bit of a deep dive, Lloyd, on, where you see the main opportunities? You did speak about more alignment between the valuation exercise itself and, the actual process of underwriting a deal or looking at an acquisition, but can we sort of go into a little bit more detail on the opportunities and maybe how this helps, with your investors as well as a part of that process?
Absolutely. So yeah, we have in the mandate that I cover, we have about 150 separate clients. So we get a lot of questions every quarter from a variety of them, and many of them are global investors. They've got portfolios in our Asia Pacific business and our US business, and they run their own models, which are all DCF. So they ask us for inputs regularly for their models on our portfolio, and I'd say probably 60% of the requests, 70% of the requests we get in are looking for DCF output metrics. They want to know what the exit cap rate is. And prior to having DCFs in-house, we were having to explain every single time how an equivalent yield is calculated and what the difference is. And it wasn't very helpful to many of them. So it's been massively beneficial for us to be able to just be comparable on a global scale. And a lot of our clients who are more accustomed to traditional UK or European investment accommodate both and can work with DCF inputs and outputs just as comfortably. So it's been massively beneficial to us.
Okay. And so that comparability, which we hear constantly, from these global investors, probably more versed with DCF, is sort of the narrative that we're very familiar with in Altus, given our North American footprint as well. From a valuer standpoint, Pierre, I mean, how do you see the benefits here of being able to drive more comparability? Okay, there's more valuation assumptions embedded, in the DCF, which maybe introduces other challenges. But what is your view from a valuation perspective on achieving this consistency?
Yeah, I think that there is several things here. First of all, if we just take a step back, if we look at it from a traditional point of view, when you do a traditional valuation, you can be extremely explicit because you can reflect turn and break, you can assume voids, you can reflect capex. So you can be explicit, but what's the part which is missing is obviously the inflation piece and the growth piece. And it's true that especially in the time we are living at the moment with high inflation, I definitely agree with what Lloyd was saying before, that DCF is really important because it helps you to understand where the income stream is going to go. And it's one of the key discussions. So I think that our clients are seeing a benefit in moving towards DCF because it helps us to understand a little bit more detail, what's going to happen in terms of income stream. Then from a comparison point of view, a lot of our clients are exposure in different parts of the world, and they want to be able to compare potentially their portfolios, their performances one against the other. And using DCF, which is a methodology, as you were saying, which is very well used in the US, but also in APAC, help them in going to this kind of comparison exercise. So I think that when we do DCF, there might be a little bit more granular analysis around the assumption and how it has been approached. So yes, I agree, it might open a little bit more discussion on some parameters, but it's also part of our valuation process anyway. Even if we were doing traditional and through your initial yield or equivalent yield, you will capture what is expected in terms of growth. The DCF is another methodology that comes to the same conclusion. It's just a way to have another level of discussion with your clients, which is good because from a transparency with your clients, it's something that brings more knowledge and more discussion on the table. So I'm really keen for that.
I'd jump in and add to that's a key factor for us as a benefit of having all of our valuations done in DCF is that we can explain to stakeholders internally and to our clients what the drivers are in a far more transparent manner than our equivalent yields have moved because inflation's gone up, but the yields have moved. But no, the transactions haven't, the comps haven't moved, but the inflation's in the yield, and it's not comparable with your American portfolio. It's suddenly a lot more transparent where we can split all of these impacts out, and it helps us communicate the message, I think, more effectively, and it helps build trust with our investors.
Yeah,
I think indeed that's what we're observing. These are really the two themes that are emerging here, which is the increased transparency and the granularity of the assumptions that can be looked at in more detail. Also, from a review perspective, can be compared much easier against the internal business planning that's being made by investors. So that allows for something that's much more efficient and comparing apples to apples. The consistency across models also helps comparability across assets within the same portfolio against assets within different portfolios, bearing in mind that, because of the difference in approach, one being implicit, being the more TradVal being more implicit, although you can bring some granularity to it, of course, one being explicit with the DCF, but also some of the captions are treated differently. CapEx, for example, are treated differently in both methodologies. The apples to apples comparison becomes much easier from that point of view.
And maybe on that same train of thought, Nicholas, if we think of some of the challenges, and you and your valuation manager role are, in the front line here, along with the valuer and the client. But what would you say are the sort of key challenges or the sort of obstacles that you tend to observe as a part of these transitions with your clients?
Yeah, I think the main challenge and the discussions very quickly revolve around the discount rate, which is the last element and probably the most difficult element to narrow down when building a DCF. From a build-up approach perspective, I think it's important for the discount rate to be comparable across assets. It's very important for all the elements that come in the DCF in the actual cash flow projection to be modeled with as much transparency as possible. Thinking about especially the inflation, the growth rates that Pierre and Lloyd already mentioned. If all those assumptions are clear and are consistent across different models, then the discount rates will be comparable. They won't always be the same, but the difference between discount rates when comparing assets will be explainable by asset specifics. The risk, and that's quite a challenge that is observing, is to have that element of fudge that is inherent to the traditional valuation approach, and to have that follow through in the DCF, because maybe some of the assumptions that should be happening in the cash flow itself are not fully explicit, and then the discount rate loses part of its meaning because it becomes an adjustment variable to target a value, which is a little bit going the other way around.
Well, it's a smaller piece of fudge, right?
It reduces, exactly. That's maybe that can be the key benefit. It reduces the amount of uncertainty, of unclarity, by clarifying all the other parts of the puzzle.
Yeah, I think you're absolutely right. I think that the beauty of the DCF, if we can put it like that, is that you will have to be explicit with everything else. So we use what we call valuation guidelines when we do portfolio to get the approach being consistent, which is very important because we are coming back to the comparison point we were discussing. But if you are approaching in a similar way in terms of explicit assumption, your valuation, your discount rate, if you look at it as the last element of your valuation part, should not show so much difference. Obviously, your discount rate will be a measure of risk. So depending on how explicit, implicit you are in your valuation, you will have, as you were saying, Nicolas, some movement in that. But as you take an approach which should be consistent across the assets, it will help you in limiting this change. But I think that there is also something important, I was mentioning on, I think it was on your first question, Julien, that in a lot of countries across Europe, the valuers are using DCF and also traditional. And there is a reason for that, is because the value of an asset should always come to the same answer depending on your methodology, but the value is the value. And what is important from a traditional approach also is that you're going to look at your assets through an initial yield or an equivalent yield in the UK. But the reason why we do that is because a lot of the comps that you will get on the market would be on an initial yield basis. I don't think I've ever seen in the press a comp with all the details of the DCF, which was underwritten by the investor. And this is something which is also very important. As a valuer, and I'm talking with my valuer's hat on, you have to be able to prove that your valuation is embedded in the market. And to do that, you need to reflect what are the comparables in the market and where the market is going and what's happening in the current market. So your comps, which will be in the press, would be usually expressed as a price and a yield. So it's very important to be able to look at the valuation you've done in DCF and, assuming your asset is more or less stabilized, look at your initial yield and say, does it make sense in the current market? And I think that this is something which is very important. So when we speak about moving to DCF, yeah, I think that it's at the moment something where we see more demands and there is more question from our clients about DCF going forward. But I don't think that the old traditional approach is dead as well. It's still a way to review our valuation and make sure that it makes sense in the current market.
So that's a great point, Pierre, because you're basically saying we're always going to use somehow TradVal potentially as a sounding board just because of the way market data and comps, are factually available, and that is the closest tie to perhaps using a TradVal, whereas moving to a DCF where your set of assumptions, and you could argue that the comparable and the volume of comparables is slightly different. If I make an analogy with North America, you have discount rates and cap rates available as market information, and we can even benchmark those assumptions. We're probably very far from that in Europe, but do we think there will be progress made over the near future on having some of those comps more, I would say, relevant to a DCF type of valuation, or by default we're going to stick to TradVal as a benchmark or a sounding board? I mean, I want to open up the question to you guys. I know it's a complex one, but just getting your views on that's more how we're going to evolve from here onwards as a market. Who starts?
Take this one. No, I think that I'm just going to start. I'd love to be able to get all this information, as you were explaining about the US example, and being able to get a lot of information about how DCF were built. It will be fantastic from a valuation point of view. It will be great to have this information. What I know about the European market is that the level of transparency is not great across Europe, and this is one of our main issues as a valuer. So I think that obviously we can speak to our clients, we can speak to our capital market guys and try to get a little bit more information. But at this point in time, and might change, because if DCF becomes one of the most used methodology going forward, there will be a need for transparency. But I think that at this stage, it's something which is still a little bit difficult. So therefore, every valuer, even if they are very well versed and can run DCF very easily because they understand all the parameters and how it works, they will always look at it, taking a step back at the value and looking at it with a different way of cross-checking that the valuation makes sense to them. And I think it's very important also because it gives a comfort to the client that what we've done is aligned with the market.
Yeah. Yeah, and I think we appreciate that. We would all want there to be more transparency around discount rates, cap rates. The reality is that we're not there yet, and would love to hear from you, Lloyd, on how this looks in your world in terms of making sure there's enough comparable evidence, enough ways for you to challenge your DCF assumptions. We obviously know you work closely with Nicholas on this, which we'll hear from in a few minutes as well. But what are your views on maybe that disconnect right now between comparable evidence available, and then DCF gaining more traction?
I think there's less of a challenge than people initially think that there might be. I feel like the biggest barrier to DCF adoption is understanding and knowledge from both clients and advisors. And I think for people that don't use valuation DCFs, in fact, even investment teams often have a fundamental different understanding as to how an NPV is derived from a DCF versus an IRR-based investment valuation, right? And it's just a disconnect that people don't appreciate, that there is fundamentally the same thing, right? And having worked in an agency, I've gone through the weeks where you visit 7 clients and ask what they would consider for this logistics portfolio, and they're all quoting a 7 or 8% IRR. And the valuation team are then listening to these conversations about what investors expect as an IRR. That's your comparable discount rate, right? And it's not quoted in the news, but I think that is perhaps symptomatic of the culture. When you use a TradVal methodology across the market with a bigger piece of fudge, there is perhaps an aversion to sharing the data behind what goes into that fudge, right? And that perhaps I feel like in a more explicit methodology in a market like the US, where and Asia Pacific is actually better as well, when explicit DCF methodology becomes the standard, people are more inclined to share the data that made up their assumptions behind it. Mm-hmm. And that I feel like that culture builds, and it builds trust in the industry as well.
Yeah. So we come back to transparency, and transparency is conducive to sharing, the data and the underlying assumptions that are behind your model, which is the essence of DCF. And you both touched on some great points here that I know, Nick, in your position, you also see this. And I know there's a lot of effort done around, the consistency of the data set, the ability to then provide information back to our clients for benchmarking purposes, which obviously means you need that consistency throughout. How has that been challenging for you, trying to, juggle and work with basically both approaches?
Well, I think there's one element which is quite important, which is the transition itself from TradVal to DCF, being that a lot of the times we're trying to read a DCF through a TradVal approach, thinking about initial equivalent reversionary yields when looking at some DCF results, and a little bit to Lloyd's point that it's not as hard or as impossible as it may first seem. The equivalent yield is not, there's no translation of an equivalent yield in a DCF metric. But if you think of an initial yield and a reversionary yield, these are metrics where you can actually get some numbers that are very close. They will never be exactly the same because of the differences, the fundamental differences between a DCF and a TradVal, treatment of CapEx being one example. But they can be close enough that they become a bit of a proxy, so you can still bridge that gap and smoothen the transition from one to the other, and still have an explainable factor or an explainable route from one methodology to the other, as opposed to just looking at metrics that are completely different and explaining completely different things. The discount rates and an initial yields are completely different. You can't compare one to the other. It doesn't make any sense. But you can look at your NOI yield for whether it's a month one annualized, whether it's a year one, and that against an initial yield is something that you can draw some insights from.
And Nick, I would put forward that any client that's running DCFs for business plans or acquisitions and disposals will find more benefit out of a DCF valuation methodology as soon as they become comfortable with how the calculation methodology works, because we would have a couple of years ago sat in meetings where we would discuss what the equivalent yield was, and then we'd roll the meeting into the next chapter of well, what's our IRR in our DCF outlook, right? And in today's meetings, you can compare the discount rate the value is using against the IRR in our business plans, directly comparable. You can compare the growth rates. You can explain the differences, and suddenly you've got a second opinion, basically, on a similar basis, and that's very, very helpful.
And that's another great point, Lloyd, because you started earlier with alignment between acquisition, underwriting process, valuation, but then you extend this to business planning as well, right? So in an ideal world, you have a consistent, sort of cash flow DCF-like approach throughout, the sort of cycle, which then, makes it much more synergistic than having to switch from, a trad val method to a business plan, which, you can't really compare, apples to apples. So I think, Nick, we certainly see this as well as our clients and your clients want to leverage, valuation for other internal processes, business planning, I think being a key one, to be able to then do these variances and be able to compare, two different set of assumptions, right?
Absolutely. Understanding why a valuation is similar or different from the internal house view of a client, it just becomes very transparent to see what the difference in opinions are, whether any assumptions have been factored in differently. Think about, leakage, whether your OPEX in your business plan might differ from OPEX that are taken from a market level of OPEX in certain cases, or whether simply the view on certain internal assumptions that our clients are making on EFE levels, on lease up speed, vacancy, void, etc. That can just be compared one-to-one against the valuation, which is an independent view of what a market participant. So really, to your point, Lloyd, the second opinion on your business plan.
Yeah. So again, a lot of great points here. I mean, Pierre, you started off saying, that it's really, at the end, client, driven, whether you're looking at your investors as a fund manager, or if you're from a value or a service provider perspective, talking to your client, the fund manager in this case. How important, is I mean, it sounds like that is what prevails at the end of the day, whatever comes from, your clients in terms of expectations. The industry somehow is going to have to adapt, but how critical is data consistency, more transparency on fundamental, and it sounds like this is what's going to influence, all of everything, beneath that. Is that a little bit the consensus here, and that we're going to have to adjust as an industry based on where those expectations are?
Yeah, I think that, that was, as Lloyd was saying, when we discuss with our clients about DCF, it's an opportunity to exchange about the assumption we've used and how we see the market and what we expect the growth to be. So from my point of view, you can see that our clients welcome this discussion. And obviously, we have this approach to the valuation, which is a little bit more in depth, that helps really. And we were talking about the transparency and how difficult it can be to get some data point that help us in building DCF, but it will improve over time. I think that we are on the path of adopting DCF in quite a lot of asset classes, and more clients are questioning it. Nicolas was mentioning that he has seen an increase in requests during the last maybe 6 months, something like that. I've seen the same thing. It's true that on a lot of new funds we've been asked to pitch on, DCF is now part of the discussion, but also we have some clients who are very happy to still have their valuation done in a more traditional way, because this is the way they work internally. They are not that keen in having DCF done. So we come back to the first point, which is we need to also, as a service provider, when we provide valuation, to make sure that we align to our clients' need. We can do both. We are very comfortable with both methodology. Naturally, we will see an increase in demand in DCF going forward, in my opinion, and that's something that we are welcoming, because it's also an opportunity to be closer to our clients and have more educated discussions. So that's great for us as advisors.
Yeah. Which makes sense. And I guess, Floyd, in your role, once you've crossed the bridge and you're full or close to full DCF, I guess there's no really coming back, and I assume your investors now expect to see more of that across the board, and to be able to then have this global view on their portlios. Anything you want to add to that?
No, totally agree. There is kind of it would be very hard to go backwards. I think a big picture, if DCF is a more explicit, a more detailed version of TradVal, that TradVal itself is a more detailed version of just doing comparables per square meter, right? And I imagine, I wasn't around 40 years ago, but I imagine that a valuation paper with a series of comparables saying, you sit in between per square meter this much, 40 years ago was a valid approach. And then people said, well, you've got to factor in the market rents, you've got to do a term and reversion, right? And then to an extent, you have some markets where you've got rental growth being double, 3 times higher than inflation, and suddenly investors are asking, well, how are you factoring that in? So I think as investors have become more sophisticated, the expectations of how you evaluate the price as a market participant becomes more sophisticated as well. And I think aligning the methodology with how capital markets teams are analyzing the same cash flows, how investors are analyzing the same cash flows is only a good thing.
Yeah. So I think that consistency throughout makes complete sense. And Nick, I do want to let you comment on that as well, because it's also about the analytics that you can provide, off the back of having that sort of consistency throughout, which I know is something you're very active on.
Yeah, the point I wanted to make is that not only moving to a more transparent and granular approach through the DCF, but moving to a more aligned approach across everything, all valuations, that opens doors to a much more detailed, much more powerful analysis that can be then done based on the output of the valuations. The granularity of the models allows you to understand how much of your value is driven by these explicit assumptions, how much of that value is driven by the inflation assumptions, how much is driven by the value growth, and if you compile that on an aggregated scale, you can look at that not only on a single asset but on a portfolio of assets, and start working out some very, very insightful attributions on valuations, which is to some degree can be done on traditional valuations, although in less granularity, but certainly on a pool of assets done on multiple valuations, that becomes very, very difficult to draw anything meaningful out of such numbers, simply because of the different approaches. So I would say the added level of detail is a very big plus, but also the added level of consistency across valuations is also a very big plus in itself.
I would even go further, Nick, to say it's the added level of comparability across real estate and other investment asset classes as well.
Yeah.
We've got clients for whom real estate is 5% of their allocation, and guess what? All of their other allocations, they do DCF models for those, right? Their private equity industry are doing DCF models, their bond portfolios, their equity portfolios, they're doing DCFs for a lot of those.
Yeah.
And, doing 3-statement cash flow modeling. And I think for some of those big, larger investors, moving into alternatives, in real estate being one of the alternative classes, is something that's becoming more and more interesting for them. And being able to provide them with comparable metrics that they're used to seeing will help grow the amount of interest that people have in it as an alternative asset class, I think.
Yeah, so it's not just about comparing to your peer set as a real estate player. It's comparing, real estate to other, asset classes, and then driving more transparency and potentially helping as well in terms of, having more global capital allocated to the asset class. So this all makes sense. I think in terms of the agenda, we've kind of covered quite a few topics. I do want to get your thoughts on the last sort of piece, which is more the outlook in the next 24 months. And we're going to go around the table here. Pierre, if you needed to make some kind of outlook on what the next 24 months are going to look like in terms of trend, what's your view?
In terms of DCF adoption, not property trend, not property value.
Yes,
I won't comment on what's going to happen in the next 24 months. But no, I agree with what has been said. I think that, we've used words like, clients being more sophisticated. And I think that it's a trend. There is a need for that. And the point Lloyd was just making about comparison, being able to compare different type of investments through cash flow can be something also which is very relevant. And it's relevant to his organization, but also our clients. So I definitely believe that there will be more demand. The industry is ready. We have the people who can deliver. So that's the most important thing. Our people have been trained already and they know how to use DCF. So we don't see that as a major issue. It's just being alongside our clients to make sure we make it happen step by step. I think that Nicolas mentioned about transitioning from traditional to DCF, and it's true that it takes a little bit of time because there is an educational process as well to be done, and we've done it already with some clients. It went very well, and I think that this is why we'll see more clients moving towards that direction during the next 24 months.
Yeah, and no, makes complete sense, and maybe Lloyd, any further comments?
I think so. Well, Invesco Europe has quite a few separate mandates, and a few of us have moved into full DCF across the mandate, and it's made internal business planning significantly easier for the teams on the ground working on asset management in different markets. And now a lot of them are working across multiple mandates and saying, well, it would be helpful if they had DCFs for some of their other mandates, because they can refer across internal business plan and DCF and sing from the same hymn sheet, so to speak. So I think there will definitely be a move across a lot of our other mandates towards that, as and when they have the opportunity to do so, because there seems to be a growing demand for it once people get comfortable with the methodology.
Yeah, well,
and I think there's a natural point at which that transition can happen is simply when there is either a valuer rotation or a mandate being renewed, which is when it creates the opportunity for a new specific requirement to be introduced in an otherwise rolling mandate. And it's also something that we're seeing, that we've mentioned a couple of times, that there is this increased demand. That demand is, in my experience, often formalized at that point in time.
Yeah. So there are compelling events, Nick, to your point, when there's a rotation, and in some cases when you have several appraisers working on the same mandate, you also want to have that consistency. So I think we kind of covered the core of what we wanted to cover, guys. So this has been very very rich in content. I think we covered a lot of the key sort of themes that we had identified before the session. Maybe as a brief recap, and it feels like we could have a follow-up session, maybe a part 2 sometime next year, Pierre and Lloyd, if you guys are up for it. But it would be great to kind of see where we stand and where the industry stands, in the near future on this. I think in terms of key takeaways, I think there's a consensus that DCF, the transition is definitely in motion. In Europe, it's really driven by client demand, whether your client is an investor or if fund managers is your client as a value or service provider. That is really what the driver is. There is a sort of phased adoption process. It's not going to happen overnight. We mentioned the transition, making sure that it happens smoothly, it doesn't create volatility or inconsistencies in the process. So we have to make sure that happens smoothly as market participants. But ultimately, investor demand, prevails, and if this is, how they start looking at the investment world, then obviously, real estate is going to adapt and will adapt as market players in that space. DCF adoption, as you both know, is a big theme for Altus. We believe in it. There is a North American footprint and the way we approach this. But it's great to have the views of industry leaders. So I want to thank you again, Pierre, Lloyd, and Nick, for making the time out of your busy schedules, because this is really great for me to moderate, and I feel we have helped answer or clarify a lot of the questions that are currently outstanding. So thanks again for your time.
Thank you.
Thank you.